Banks really don't like you to just say, well, I need the money, do some advertising, or I'm going to pay, want to have some reserves. How does this fit into the structure of your business? There's something called the 5 C's of credit that underwriters look at. It's character, capacity, capital, collateral, and conditions. So what that means, character is you as a person. Are you a trustable person? Do you have a reputable business? They actually look at things like that. They look to see if haven't had any issues, no troubles, no background history, no bankruptcies in your past, or things like that. Capacity means the ability to repay. Do you make enough money to actually service this debt that we're going to provide to you? Capital, the amount of money you have in reserves to pay for something. The collateral, that's what you're putting up. A lot of times it's real estate. In some cases, it's just the assets of the business. It's a blanket lien on the business assets. Conditions, so we were talking about that earlier, right? You had conditions with renewing a loan, right? There's certain things that they expect that you have done, and when they come back and they say, okay, well, are you meeting these conditions or not, and why, and all that sort of stuff. Other things to consider, typically there should be a need for the financing. Now, it could just be, we're gonna buy a building, we're buying a piece of equipment that we're gonna use for plumbing jobs, things like that. Those are clear needs, right? It's pretty obvious, doesn't require a lot of explanation. Sometimes it's more open-ended than that. Banks really don't like you to just say, well, I need the money, do some advertising, or I'm gonna pay, want to have some reserves. Like, what's the plan? How does this fit into the structure of your business? Telling that story and being honest is always important. Large banks, smaller banks, a lot of things that are done at the larger banks, and nothing against like the Bank of America's, Wells Fargo's of the world, or any of those. It's all very automated, and you have to just fit in their little box. And if you don't fit in their little box, then you're not going to be able to get anything done. So that's why a lot of times it's better to go to a smaller bank. They can think outside of the box. They have the ability to help understand your business. It's just different needs, different situations. Now, no bank is advertising outwardly, hey, we only do plumbers, we only do electricians. They don't do that, but if you have a relationship with somebody that works there, they know what the bank likes, they know what they have an appetite for. Some banks really love to invest in multifamily. Shane just said they do construction. A lot of banks don't do construction. So there's a lot of different niches within the banking industry, and kind of knowing that and leveraging that helps the business owner, helps you save time and save money. Keeping the books clean. Now, that's near and dear to my heart, because that's one thing that I help advise people on. Make sure your books are clean. Make sure they match the taxes. Don't wait 6 months to prepare an interim statement. To me, a business owner shouldn't be the one doing the day-to-day bookkeeping and keeping track of all their accounts and their cash positions and all that. They should outsource that to someone else, me or someone else, because their time is better suited growing their business, whether it's sales or whatever they're doing. If they bill by the hour, they can focus on their business and have someone else help focus on the day-to-day finances. But I see a lot of times businesses that the owner's still doing it, or they do it every other month, once every 6 months, whenever the bank asks for a new financial statement, and that's not really helping them. They don't really know how they're doing other than just seeing the cash in the bank. And that's not always the best guide into how healthy your business is doing, because something could happen. You could lose a big client, you could have an employee leave. There's a lot of different factors, and having somebody that sees it and looks at it every day is important, just for a number of reasons. But specifically with bank lending, they do look to make sure, are you keeping accurate books? Does it match the taxes? All that sort of stuff. This is a big one too. Paying less in taxes may limit your ability to grow. Businesses will go into their CPA at tax time, say, I want to pay as little as possible. And they'll have their CPA will advise them to do things like spend $100,000 so you can save $20,000 in taxes. Now, I don't know about you, but that's not really a great investment. You're basically spending 80 to save 20. It doesn't really make a lot of sense. In some cases, if you needed the thing that they were advising you to do, obviously that makes sense. But sometimes paying a little more in taxes will help your business in the long term. It'll keep money in the company. It will allow you to go to the bank and get financing You don't have to go to alternative sources of lending, which I'm going to talk about a little bit, and also telling your story. So when I was a banker, we used to have to do a long write-up to give to our underwriters, and it was always like the story of the business. This is how they started, this is who their customers are, this is who their vendors are, this is who they work with, these are who they know in the community, these are organizations they're involved in, basically the whole story. So it was important for me to know that about my clients so I could share that with our underwriters, because believe it or not, but they're humans too, right? That all makes a difference. They look at it and say, oh, this is a great story. This is a good little business, family run, and it helps. All right, so this is the fun part. We've got two businesses. You have the roofing contractor, the law firm. They're both very similar. They both have the same revenue, $1 million. They both have the same net income, $50,000. One's paying $50,000 in taxes. One's paying $14,000 in taxes. One owner takes $200,000 out of the company as a salary. The other one only takes $40,000. So on the surface, that might seem conservative. Well, they're not taking that much money out of the company for themselves. They're being frugal. This person got a huge salary they're taking out of the company. On top of that, they have $1 million mortgage on their home. They have $20,000 in credit card debt. The other one, much more modest, $300,000 mortgage, no personal debt. So the question is, which one is gonna qualify? The law firm doesn't have a lot of overhead, which is why they're more profitable, which is also why they technically don't really need a line of credit, right? Maybe because they have some costs, maybe they had to do some research, they had to pay experts. You know, there's some money that they could use a line of credit for. They don't really need a line of credit. The reality is the bank is gonna be way more likely to give that business the money than that business the money. And it's mostly because they're showing more profit, they're paying more in taxes, so even though they have more debt, they've got more cash to service that debt than the roofing company. Now, what can the roofing company do? They can maybe cut some overhead, like you said. Maybe they need to increase prices. You know, their margins are obviously thin, but they have a need, right? Roofers usually have to wait to get paid. They have to buy materials. They're not getting usually paid up front, at least not from individuals. And even then, the insurance companies take a long time to pay. So there's definitely a need there. It's just a matter of what do they need to do creatively to be more appealing to the bank? What can they do? That was my little example there. There's alternative sources of lending. A lot of you may or may not have heard of some of these, but there's non-bank SBA lenders. They essentially act as brokers. So just like a residential mortgage broker, they're a little less restrictive than a traditional bank, even a bank that does a lot of SBA lending. They're gonna have more fees associated, but they're often faster. So you could also get financing faster. They like a lot of franchise model businesses, a lot of real estate usually, things like that. Invoice factoring, that's another great option for people that have large contracts. Maybe they're selling to, we were talking earlier, the government, or they're selling to a Walmart or a Target, and they have to produce product that they need to get onto the store shelves so they can make money. Factoring is a good option for them because they get paid up front and the fee just basically comes out of what they sell. There's also companies that are fintechs, Cabbage, On Deck, Blue Vine, there's a bunch of them. Some of them are good, some of them are bad. The good thing about a lot of them is that they're fast. The problem with a lot of them is their fees and their interest are a little vague and fuzzy in a lot of ways. So it's very high rate, expensive financing. The benefit is that it's quick and really it's much easier to get. So if you don't qualify through a bank, that's an option, but it's definitely not the best option. And then there's also any platform that takes payment. So QuickBooks, Square, Shopify, PayPal, all of those companies will essentially finance your future merchant advances. It's very expensive as well. Think it's similar to like a payday advance, right? People that go to a check cashing store 2 weeks before they get paid to get their money up front. Same idea. Obviously, it's very profitable for those businesses, and some people have no choice or they have to do it. Getting your books in order, getting your house in order, controlling your expenses is going to be a way better ROI for the business than trying to go to people like that. And then the last one, there's a lot of private hard money lenders. Usually those are going to be people that are doing real estate transactions that they need to go through something like that. And I'll just touch briefly on some of these things. So venture capital firms, usually they're pooled money of investors. They like high growth companies. They like businesses that have a specific strategy or something that's proprietary, that's gonna grow really fast. They'll offer advice. Usually the owner is giving up equity. So like if anyone's ever watched Shark Tank, that's technically venture capital, right? Like you're bringing in Mr. Wonderful because of all of his connections and all that to help grow your business, and you're giving up a percentage of it. In some instances is what you have to do. A lot of times though, like going back to the roofer example, a roofer, they're not gonna be a target for venture capital because they're not creating something brand new, it's never existed before, they're not gonna scale fast, it's, unless they came up with some software or some niche that's never been done in the industry before, it really is not something that is going to be a target of a venture capital firm. Very similar, but slightly different would be angel investing. Angel investing usually are individuals. They might have a little less structure because the venture capital is a fund and they have objectives and goals and you're expected to meet those metrics. Angel investors may be a little more loose on that. But again, it's also, and I didn't touch on it, but the bottom point there, you have to have a great story, you have to have a pitch deck, you have to have clean financials. Those are all kind of a theme throughout, but especially for this type of stuff. So if somebody is involved in any of these type of things, you definitely have to probably pay somebody to create your pitch deck and what your business is all about, what your focus is and all that. And then finally, this is usually a lot of small businesses' exit strategy. A lot of businesses get acquired by private equity firms, and that's how they get out of the business. That is similar to venture capital, but they're usually looking for regular old conservative businesses. Like they don't need to be high growth, they don't need to be high revenue or creating the next Uber of the world. It's your roofers, your attorneys, your accountants, CPAs, all that sort of stuff.